Interest rates come up a lot. I get asked this question quite a bit about how higher interest rates are going to affect real estate. Just to review, two things have happened over the last 18 months. One, LIBOR, which is measured as sort of the risk-free rate, and all of our loans are measured above LIBOR as a spread. So if you hear in real estate borrowing, I'm borrowing at 250 over LIBOR, that's 250 over the interbank lending rate. The interbank lending rate is directly correlated to the federal funds and the discount rate. That's what the Fed is moving. As you hear the words, they're tightening. That's what they're moving. LIBOR correlates with that almost all the time until it doesn't. And I'll give you an example. In a financial crisis like 08, 09, the Fed can be cutting rates, which they were, but if banks are afraid to lend to each other because they don't trust each other's ability to repay, which happens in a situation like 08 and 09, LIBOR won't go down with Fed funds. The joke in the financial crisis was LIBOR is the rate at which banks won't lend to each other, right? And basically they wouldn't lend to each other at any rate. So LIBOR is whatever you want to claim it is in a given day. But 99.9% of the time, LIBOR correlates wholly with Fed funds and the discount rate. And so over the last 18 months, as the Fed has been tightening, LIBOR also has been going up. So what does that mean? Well, what it means is unless those spreads move in, then your total borrowing rate is going up, right? So for example, if I was borrowing at 250 over LIBOR 18 months ago and LIBOR is 0, then my total borrowing rate is 250, 2.5%, right? So that's a very low borrowing rate. Now, if the spreads are the same and I'm borrowing at 250 over LIBOR, well, LIBOR is also 250. So now my total borrowing rate is 500 or 5%. So it's doubled. What's happened as LIBOR has gone up with Fed funds, because the Fed has been tightening, the spreads have come in. And basically the banks and other lenders have said, we're willing to eat some of that by just making less money on our loans. So they're not charging 250 over, they're charging 200 over. But still, I used to borrow at 250, now I'm borrowing at 450. That's quite a bit higher. So what does that mean for real estate? There's two things, because there's no question that borrowing costs have gone up. The first is it's going to have an effect on my income statement. And what I mean by that is if everything else is held constant in a real estate deal, if my borrowing costs went up from 250 at a 0 LIBOR, so 2.5%, to now it's 5%, obviously there's a lot less free cash after debt service. So when I'm looking at my income statement, it's top line, revenue, expenses, yields, net operating income. Net operating income, then I have to subtract out cost of debt. The cost of debt's much higher, so my free cash, that's what's available to investment partners, equity partners in the deal, is lower. That's the first effect of higher debt. The second effect of higher debt is actually your balance sheet, which is what the asset is actually worth, right? So what's happening to the asset when I sell the asset for our investment partners? Everything else held constant. If you have a higher cost of debt, that's increasing what's called your weighted average cost of capital, which essentially is the denominator in the terminal asset valuation. And so if I hold everything else constant, what I'm telling you is your asset value on the balance sheet, the actual value of your asset, should be going down. And that's why when you hear anyone talk about the stock market, it's not just real estate, it's any asset, any capital asset. If you hold everything else constant, assets should be worth less in a higher interest rate environment. One of the ways to think about this is very simple, is if I said to you, you can make a return of 5% and take no risk, or you can make a return of 2% and make no risk, which of those two things would incent you more to move to a risk-free investment? Well, obviously you would want to make 5%, right? Well, that's essentially what's happened in the market, is the risk-free interest rate has gone way up. And so people are more likely to invest in risk-free assets versus assets you take risk in. Real estate, if you invest in private real estate, there's risk in it. Same in the stock market, same in the private equity market, same in the venture market. Same in any capital asset. So just from an investor psychology standpoint, it should make sense that as the risk-free rate goes up, capital flows will tend to move into that risk-free asset because it's incenting them to do more of that, right? We were in a zero risk environment for literally years and years and years, and it incented capital to move to risked investment. It incented you to take risk. Now the Federal Reserve is saying, well, actually the economy is growing at a rate that we're happy with. And, you know, look, unemployment is at such a low level that we're actually starting to get concerned that there's going to be inflation in the labor market. Because that's really when inflation starts to get out of hand, is when it hits the labor market and the commodity market. So they're now saying, well, we actually want to shrink our balance sheet, right? So when the Fed is shrinking their balance sheet, they're actually unloading their assets to banks, and the banks are now tying up money they could be lending in their securities, right? So there's less money floating around the economy, but then they're also raising rates. Both things are creating a higher interest rate potential environment. And quite frankly, that's what the Fed wants right now, because they believe the economy might be a little bit overheated.